Hello there, Parallax traders, and happy Sunday. This is Imri, and in today's video, I want to cover a really important technical concept, which I call pivot points. Now, pivot points are nothing new in and of themselves. There are a number of different indicators out there that will automatically calculate Fibonacci pivot points, standard pivot points, Camarillo pivot points. If you go on TradingView and you open up the indicator list and you type in pivot points, there will be any number of different options you can choose from. How we use pivot points at Parallax, however, is a little bit different. We use a combination of Fibonacci relationships between waves, of course, always using the Elliott Wave principle as our foundational methodology for market analysis. But in addition to those Fibonacci relationships, we're also using Elliott's rules and guidelines in order to help pinpoint specific turning areas or specific areas on a chart where the market might turn. So what we're looking at here right now is a fairly short-term chart of the dollar Canada currency pair. Here we have dollar CAD on a 1 hour time frame, and this is what one of our analysts, Robert, published on April 20th at 4:30. We were tracking dollar Canada in anticipation of a short-term trade to the upside, and as you can see here, according to Robert's labels, he could count a complete 5 waves up to the upside. Now that's really exciting because it tells us that after an ensuing corrective wave will occur, we should see another impulsive 5-wave count to the upside, at least one more, right? So as you can see here, Robert's labels on this price chart indicate that he's looking for one more push down and then we complete wave C, at which point the market should rally strongly. And if I go to what Robert actually wrote, he said, if I'm correct, we need one more small wave down to complete wave C, then we're off to the upside and can't go below the inval line, of course. Inval is short for invalidation level. And we can see here we've got that invalidation level around 124.04. So we have a line in the sand where the market cannot go past this point. Otherwise, our bullish thesis on this currency pair is incorrect. And furthermore, based on the developing wave structure, Robert said we need one more push down in wave C to complete this corrective sequence. So let's take a look at what actually happened. So where Robert had that label where he was expecting one more push down was right around here. So we did get that one more push down, and then look at that reaction. The market shot up quite strongly. So the question is, how could we be so sure that the market was going to take off very strongly from not much further below from around the 125 handle? And the answer lies in how we applied this concept of pivot points, of finding areas where the market is ripe to turn. This is a crucial concept to understand in technical analysis, regardless of whether you're using the wave principle or not. And there are countless other methodologies out there that look to identify high probability turning points. Now, I'd be remiss if I didn't mention Wyckoff, for example. I'm planning on doing a video in the future where I do like a compare and contrast between Wyckoff and Elliott waves. And in my opinion, just my opinion, you can certainly come at me in the comments if you want, but I find the wave principle a superior methodology because it accomplishes what Wyckoff is so good at, which is finding those key moments on a price chart where the market is going to turn and turn violently. But where it has an edge over Wyckoff, in my opinion, is that the wave principle gives us context. So it not only gives us an upside target, but it gives us an expectation for how the rest of the pattern is going to unfold and play itself out. And I believe that market context is essential in terms of being able to accurately identify these turning points, these pivot points on a price chart over and over and over again. So there are two kinds of pivot points in the market that we look at here at Parallax. The first is where we're going to find stopping points for a corrective wave sequence. And then, of course, the next kind of pivot point that we want to identify is where we can expect the next impulsive wave to kind of run out of steam and the next corrective wave is going to take over once again. So in this video, I'll be covering the first kind of pivot points, which is where we try and determine where a corrective wave is going to stop. And I'll be using this dollar Canada trade setup that we called out in our Discord server as an example. If you're interested in joining the Discord server, please leave a comment. We try and get back to everybody, and I'm more than happy to send you an invite link to our Discord. So without further ado, let's get into some concepts. So what we need in order to start looking for high probability turning points in regards to corrective waves is a completed 5-wave sequence first, right? A completed wave sequence, I should say. So once we could count 5 waves to the upside here, 1, 2, 3, triangle 4, wave 5, we can of course expect an ABC corrective sequence to then take place. All right, so what we know is that this 5-wave sequence up is either wave 1 or wave A. Remember, wave A of a zigzag will also unfold in a 5-wave sequence. So that means this corrective wave is either wave 2 or wave B, and the ensuing rally will be either wave 3 or wave C. So those are just some general Elliott wave principles and guidelines and rules that I just wanted to lay out so you have an understanding of what kind of possibilities we're considering when it comes to working with the current pattern in dollar Canada. In any case, once we have 5 waves up and we're looking for that 3-wave corrective decline, what we should always be looking to do is to draw our Fibonacci retracement levels over this completed wave. So I'm going to, as you can see, I've drawn my retracement levels from the low at 124.02, really 03 if we round up the last 2 pipettes, and then up to 126.76 to the upside. Now, if we're dealing with a wave 2, then we can typically expect, according to Elliott's guidelines, a sharper correction in wave 2. Wave 2s commonly retrace 61.8%, 50% is another very common retracement objective. The only hard rule is that wave 2 cannot retrace more than 100% of wave 1, which is why Robert had that invalidation level down here to begin with. All right, so like I said, we are looking for some common retracement objectives. Obviously, the 61.8% is something that a lot of technical traders know and understand. And from a Wyckoff perspective, traders look for those order blocks down very deep in the retracement zone of a completed impulsive wave. However, what's really important to note here is that because Elliott Wave gives us context for wave 2s and how far they should go, that gives us a really good expectation, again, of where we can look for support in the market and where we can forecast future resistance as well. So that's the last time I'm going to mention Wyckoff. And on a personal note, I'm a huge fan of Wyckoff. I believe it does complement wave analysis very well. In any case, so obviously we took out the 61.8% retracement level and we found support at the 78.6% retracement level. Now, at the time, as the market's selling off, if I just use the replay feature and I go here, and I think it can be tempting to claim that wave 2 is all done. We have a steep 50% retracement and it's time to start looking to the upside. However, and again, this is where the wave principle is such an asset to us, this decline is incomplete. And the reason it's incomplete is because corrective waves unfold in 3 waves, right? Especially in wave 2, we need to see some kind of 3-wave price correction. And there's no way to count this as 3 waves. It's just 1 wave for now, which means we still need another wave higher and then another wave lower to complete wave 2. Now, this is assuming we're working with a zigzag. Even if we're working with a flat, which is another one of the core Elliott wave patterns, then we would still see something like this. So we should still see prices make a new high or close to a new high, maybe a double top up here, and then a flat correction will terminate around here. So regardless of whether we've done enough through price, regardless of whether we've done enough in terms of the Fibonacci retracement, the market structure tells us quite clearly that this correction cannot be over quite yet. We still need more price action to develop. So all we can do now is wait. Now, one of the guidelines of Elliott's depth of corrective waves tells us that corrective waves, as they unfold, like to find support near the extreme of wave 4 of the prior wave of 1 lesser degree, which would be the 23.6% Fibonacci retracement level, which would be very unusual for a wave 2, right? Remember, I said wave 2s tend to be quite steep. So we're looking towards at least the 61.8%. So I think we can safely rule out the odds of this wave 2 finding support at the prior extreme of the last of this wave 4, I think we can rule that out pretty safely as being an unlikely possibility. Not impossible, but unlikely. So the next guideline is for corrective waves to find support near the extreme of the wave 2 of one lesser degree. Now that makes a lot more sense. That makes a lot more sense given where that extreme is relative to the Fibonacci retracement levels of waves 1, 2, 3, 4, and 5 here. So that's kind of smack dab in between the 618 and the 78.6 retracement levels. So as the market unfolds and we get wave B, we can start narrowing down our calculations a little bit further. So one common relationship between waves A and C is that they tend to be relatively equal in size. So this means that if wave A down here is approximately 153 pips, then wave C should be approximately 153 pips as well. And in TradingView, there's a great tool that we can use called the trend-based fib extension tool, which requires 3 points of contact. So the first point of contact is the start of wave A, the second point of contact is the end of wave A, and the third point of contact is the end of wave B. And we can see that that equality projection measures out to 124.92. Okay, so now we're building a cluster of supports. We can see that the extreme of wave 2 comes in right around here, very close to the point where A would equal C. And then if I go back to my retracement levels, we can see that that's right between 618 and the 78.6%. So I think this whole area, just to start simplifying, this whole area between the 618 and the 78.6% is likely to function as a pivot point in the market. And now we can start adding other complementary tools to our technical analysis. Now, I love using momentum indicators like the RSI, for instance, not on its own, but in conjunction with Fibonacci analysis and, of course, wave analysis too. So let's see what happens as we head into that pivot point. Okay, so you can see how oversold the RSI got. Now, RSI being oversold on its own doesn't mean anything to me. It means something in context with what price is doing within the larger structure, which in this case is completing a corrective sequence. And when we're completing a corrective sequence, I would expect to see RSI get oversold. It doesn't have to, but it's another strong confirming piece of evidence. All right. So we found right within the pivot point, which is really the area between the 61.8% and the 78.6% retracement levels, we also have a sharply oversold RSI. And we can also count 5 waves down for wave C of a zigzag. So remember, in a zigzag is a 5-3-5 pattern, meaning wave A will count in 5 waves, wave B will count in 3 waves, and wave A will count in 5 waves. So we have all the ingredients in place to set the stage for an exciting reversal. And we know where we're wrong. We know we cannot get below the extreme of wave 1. Otherwise, this area is wrong. And again, this is why I love the wave principle. We have very clear parameters for where our thesis is simply incorrect. And we have a very high probability methodology for identifying turning points in the market, again, with a high degree of confidence. And then we can add an Elliott wave channel. So if I channel this entire corrective sequence, you can see we poked through the underside of that channel very briefly and then shot back inside of it. So we have so many technical factors all coming together in a fairly narrow range on this price chart that allows us to start building a case for risking some capital with a higher degree of confidence. All right. So that covers how we look for turning points as we're anticipating the end of a corrective wave. Next video will be how we identify turning points in the market once as we're looking for targets, either to the upside or to the downside, depending on whether we're going long the market or short the market. If you have any questions, please feel free to leave them in the YouTube comment section. Please come aboard our Discord, and I'll talk to you guys soon. Good luck in the upcoming week.